So Palo Alto Networks, well, we all know the sell-off after announcing the acquisition of CyberArk Software. And I have to say that that sell-off was unwarranted, unjustified. And this is probably the reason why today in the pre-market session, after announcing fiscal Q4 2025 results, shares are up in the mid-single digit. And I'm going to be direct and go straight to the point. The main reason I like this acquisition, even though it represents inorganic growth, is because Palo Alto is in a path where it is seeing its revenue stagnating. So you can see there the guidance. I'm probably going to move my profile around. There we go. Guidance for fiscal 2026. We're talking about 14% year-over-year growth, considering the midpoint of this range. 14% is not particularly exciting, especially in the current AI supercycle, where software companies have to show at the very least 30%. You know the rule of 40? Yeah, so you have your revenue growth and your either EBITDA or free cash flow margin. I think Palantir is using free cash flow margins, I believe, for the rule of 92, I think it was in the last quarter. Back to Palo Alto, that is not exciting. And, when you look at the revenue growth of the company for the past 10 years, 15 years actually, which is crazy. Just look at that chart, hopefully you see it. The revenue guidance for next year is the lowest in 15 years. And take into account that, we are in an AI supercycle. So you are expected to show growth and investors are paying for growth. If you're not showing it, you can be, improving your free cash flow, adjusted free cash flow margins. You can be improving your profitability, but that's not what people want to see, especially right now. People want to see you growing. So that's one of the discontent points I have with the company. I'm not happy with this. However, this acquisition, and by the way, that guidance, so the acquisition is not taken into account in that figure, in that 14% year over year. So this is organic growth excluding CyberArk. So this is key. Let's have a look at CyberArk and see what the company is doing. This is a public company. Probably you don't know about them. I have no freaking clue who CyberArk was because it's not in my universe of stocks that I usually deal in my day-to-day. I learned about CyberArk after the press release on July 30th from Palo Alto that, they were acquiring this company for $25 billion. So this is what's happening here, We're talking about 3,800, let me move around. 3,800 employees, that was, I believe, at the end of last year, as of the latest Dev 14A. I think that's where they have to declare the number of employees. Probably the 10K as well. But I know the 14As are usually, you are required to declare the number of employees. So that's a lot of people that you have to integrate into an already complex organization. If we look at the financials, check out the revenue growth of CyberArk for the past couple of years. So I'm probably going to hide my profile because you guys are not seeing anything. There we go. So this is crazy. We're talking, when I say crazy, this is not NVIDIA. We're not talking about crazy rates, growth rates or Palantir or, CoreWeave. We're talking about, decent growth. Last 12 months, we're talking about 40% year over year, which is nice. It's a good figure. It's decent. That said, the company is not profitable. So if we look at gross profit margins, they have been declining significantly. Of course, on a gross margin perspective, the company is profitable. What happens if it's not? But when we look from an operational perspective, operating margins are negative. In other words, the company, I wouldn't say it's burning cash, but on a GAAP basis, it's not able to create positive operating or net income. And you will see later on why, but I think you already know why. Stock-based compensation is probably one of the main factors that's pressuring the stock. Let me come back. Otherwise, it's quite boring, right? If you don't see me, even though you may be scared if you see me. So, anyways, let's move on to the cash flow statement because I want to discuss that specific reason why operating cash flows are depressed. Sorry, why operating income is depressed. And usually when I look at the company's net income and it looks like this, that's scary. Okay, so that looks really bad from the perspective that, you know, we're talking about the 65 million loss in the past 12 months. But when you go to look at operating cash flows and you see this, okay, that changes the picture. So in the income statement, the company is it looks like it's burning cash, but when you look at the cash flow statement, that is an indication, or that, I don't know which way, that's an indication that stock-based compensation and particularly non-cash expenses are dragging the profitability of the company down. So when you scroll down in this chart and you look at the different contributors to, hopefully you will be able to see them. We're talking about stock-based compensation there. I'm just going to remove this value. And this is the value, as you can see, 194 million, that is depressing, the net loss, or the net, in this case, the bottom line of the company. So stock-based compensation is not a good news in regards to this stock. That said, the company is not diluting investors by, raising equity through, selling stock. So if we look at the issuance of common stock, yes, it has been increasing, it's not particularly exciting, this trend. However, the company has a good amount of free cash flow, which ends up in the balance sheet. So when you look at free cash flows, you can see the chart here. The trend looks fine. Of course, there are no capex, so this is pretty much operating income. However, when you look at the balance sheet and you look at the total cash and short-term investments, that's 1.5 billion. That's a lot of liquidity. So the company is well positioned from a liquidity perspective, and it hasn't been raising this amount of cash by diluting investors. If you look at the amount of outstanding shares, it has been going up. I agree, maybe it's not the best trend, but overall, so it has been increasing, but it's not a massive spike. So that cash that you see in the balance sheet is not from equity raising. And as I shown before in the cash flow statement, that amount of cash, and if I go back to issuance of common stock, you see, so in the last 12 months, we're talking about 47 million raised through equity. That's nothing compared to 1.5 billion in the balance sheet. So the company is making money, but unfortunately it's diluting investors by high stock-based compensation. So these are non-cash expenses. What's my point with this? I think the acquisition makes sense, and as I said before, this is Palo Alto. This doesn't look attractive at all, and this is probably the reason why I want to see an increase, even though it's inorganic, through this acquisition. By the way, as I said before, the guidance, these values, they don't include the contribution from CyberArk. So this is something to consider and take into account. And when you look at the combined company between, of course, after the acquisition, the overall target is for, let me move around, 40% adjusted free cash flow margin. But this is not a short-term goal. This is by fiscal year 2028. So that's 2 years from now. The company has a very weird fiscal year. It starts, it ends in, was it July? Yeah, it ends in July. And right now we're in fiscal 2026. It's strange. Anyways, from a free cash flow perspective, adjusted, which, it's something to consider there, probably for stock-based compensation, we're talking about 40% of free cash flow margin, which I have to say it's slightly more than the guidance for this fiscal year, which is 38 to 39%. And overall, here is my take on the acquisition and also on the outlook for Palo Alto moving into the next quarter. Let's go to have a look at the share price. I'm not going to do technical analysis, don't worry. I'm just analyzing. Am I allowed to analyze a chart without being considered as a short-term trader? Check this out, yeah? So after the acquisition, the stock went down by about 20%, okay? So what does that tell me? Pessimism. So the market was pricing in a horrible acquisition, instead of bolt-on, this is a complete merger, M&A. So integrating 3,800 employees is not easy. And I believe the market was anticipating huge integration costs coupled with possibly non-cash charges. You probably know what happens during these big acquisitions. You have write-downs, you have the company, thinking that they pay the right price, and then suddenly a few years down the line, oh, it's actually not the right price. And then they have to do write-downs. That's the biggest risk, and that's why the market didn't like this acquisition. I think investors realize that that's the wrong, I would say the wrong reaction. And in the pre-market session of August 19th, shares are up by about 5.5%, mid-single digit. That's a lot. That's a lot after the earnings session. So overall, I do think that shares are going to be trading back in the 200s over the next, I would say, couple of weeks, maybe it will take a month or so. Overall, the chart looks relatively fine. It's still bullish. You still have higher highs, higher lows, as noted by the sell-off there and here. However, the share price is struggling to break the low 200s. And this is the main reason that if I see shares back in the 200, I'm not betting that they're going to break the level. And to break that level, I think we're going to have to wait to see what the integration costs look for CyberArk moving into the first fiscal quarter of 2026. That's my take. I hope it was valuable. I guess the last point I forgot to mention, it's on the subscription. So that's the revenue contribution for Palo Alto. Most of the revenue they generate comes from subscriptions. Unfortunately, if you are into software, particularly in the firewall segment, and you're not leveraging AI, which is the case because right now I don't see growth, organic growth for Palo Alto. To me, it was a red flag in the mid to long term that 14% guidance for next year, it was quite slow considering that this is a software company, and we are in an AI supercycle where companies are leveraging AI agents. Companies like CrowdStrike are firing people. 500 people were fired back in May at CrowdStrike. And what I loved about that, by the way, is the fact that they've been replaced by an AI agent called Charlotte AI, named after a woman. I mean, give management some credit, It's insane. We are so doomed. If you're not into AI, yeah, you have your days counted. Anyways, that's it for the video. That's pretty much all I had to say. And yeah, I hope to see you in the next one.